You mentioned rationing, by the way. We got some headlines that Target is going to be limiting sales of disinfectant wipes because of high demand. So we may be seeing more of that here as well as we see U.S. stocks continue to sell off sharply. I want to turn back to the panel, including David Zervos of Jefferies, who is still with us. David, are we pricing in a global recession? And is that what is going to happen?
I think the bond market certainly is, and you could argue the stock market is pretty close to that. I think we're pricing in a very aggressive response from the Fed, and we're questioning whether that response will be enough to stop what's happening with this outbreak. And I think that's a valid question because monetary policy doesn't solve the problems associated with the virus, but it does solve some of the indirect effects associated with market seizures, and that's why we're seeing the central bank act accordingly, and I think we'll continue to act.
I do want to dig further into your note because the last paragraph you brought up something interesting, and I would love to get you to unpack it. You're talking about risk parity, which has been, a big issue. Once the rate hedge starts to become ineffective, that's what you wrote. Unpack what you mean by that.
So there's a lot there. Look, for the last decade or so at Jefferies, I've been I've kind of ridden this risk parity hobby horse for a long time, and I very much believe in the trade. It's a trade that's made a lot of very successful hedge fund managers even more successful over the years. And I do think that trade structure has embedded itself in the marketplace. And it is a trade where you're basically owning risk assets, and instead of having a 60-40 mix of risk assets and treasuries, you kind of lever up that treasury piece, that 40%, so it has enough volatility that it's kind of matching the volatility in your stock portfolio. So you may have 2 or 3 times what you would normally have on margin, on leverage and fixed income. And that fixed income has acted like an insurance policy. When stocks go down, rates go down, the value of that portfolio goes up, and you kind of live to fight another day. Once we get to zero, or close to zero, and 2-year yields were less than 30 basis points this morning, I think 25, the insurance policy doesn't work out so well. You need to have enough room for those rates to rally to protect your stock. So if there's a lot of stocks today that are owned on a risk parity basis, meaning they have a hedge in rates, and all of a sudden that hedge isn't effective anymore, well, the strategy needs to be redefined, and that may mean sort of unwinding it. And that could be another catalyst for some difficult.
Further downside? Are you thinking further downside?
Look, if we saw risk parity trades have to get unwound, it would not be pretty in the short term. It would be a pretty ugly scenario.
Would we see the unwinding start in the bond market as people tried to take what they could as far as, profits there to have cash on the side?
I think more likely what we see is the illiquidity of the stock portfolio. That's really the issue, because the bonds are really going to be pinned and underpinned by the Federal Reserve, right? The Fed's kind of setting that short rate, so they can't really sell off that much beyond where short rates are. And obviously, if stocks are going down, there's going to be a whole transformation of people that are looking for some stability, and they'll happily take a bond that isn't yielding anything, even if they know they're just going to get their 100 back. So it's worth thinking about. It's worth kind of contemplating what that means for the structure of the market. It's a trade that has, and a structure that has worked really, really well for a decade now, or more. And it's seen a lot of inflow into it over that decade. So I don't think you have a lot of people that are, say, underwater, but there's a lot of people that are going to scratch their head and go, well, wait a minute, what am I doing here? If I don't have the hedge, I got to really like the equities and really believe this is a bottom, and then I can hold it without the fixed income hedge, because the fixed income hedge is really being kind of taken away, if you will, by the perceived and likely central bank action that's coming.
Do we need a fiscal policy response to arrest some of these big swings in the markets? I mean, Jerome Powell, he's doing his job. Where's the administration?
Well, look, there's a lot of people out there that say, hey, we shouldn't be doing any monetary policy. This is not the right thing. We should be doing fiscal. It's a should kind of story. I don't spend a lot of time writing about what the Fed should do, what should happen, try to write about what I think will happen, because that's what makes people money, is getting right the actual action. You could make a great cogent argument for why fiscal policies should expand here. We have some of the lowest funding rates in history. We should be issuing 30-year, 50-year bonds and going out there and building some infrastructure, maybe building some healthcare infrastructure to combat some of these viruses in the future if they become more prevalent. There's all sorts of things that you could say would or should happen.
But will they?
But the odds are they won't. I mean, we've seen fiscal impasse. This is an election year. Can you imagine the Democrats and Republicans getting together to spend hundreds of billions of dollars on stimulating this economy as we head into November? I don't think that's going to be an easy bipartisan activity. More likely, we go back to kind of the funding facility discussion that you brought up earlier. Maybe we see the Treasury bring in some sort of fiscal funding for small businesses, try to get income tax breaks for people. There was a great blog piece, I thought, by John Cochran earlier in the week, The Grumpy Economist, if you ever read that, where he basically said, hey, give everybody the ability to borrow $10,000 from the IRS at effectively 0% against their future taxes, which will get them through the next year or two. So you pay, $1,000 a year every year for the next 10 years. And guess what? The IRS has a pretty good collection mechanism. If you don't pay, they can really hurt you. Yeah. So if there's one group that can loan you the money, that's it. It's probably even more effective than the payday guy down on the corner, and certainly more fair in terms of instead of giving the money to Jamie Dimon or Lloyd Blankfein or the big banks and then having them turn around and lend it for 25, 30, 40, 50% to distressed borrowers, just have it come through the IRS. There's many more ways you can think about fiscal being done.
Although that's also probably more creative than the.
Well, they actually sent a check to us. Do you remember back? What was it?
They did.
They just sent a check to every
George Bush
American.
sent checks. The Hong Kong Monetary Authority did that recently. It's not an unreasonable thing to have Congress pass simple things like that. What's more complicated is a big, porky spending bill that says, let's go out and change our roads or change our healthcare system. Then it just becomes hard. But simple things like changing the tax code a little bit, or what John was suggesting, instead of just giving people $1,000, basically you give people who might want it more the ability to borrow it, knowing that they really do have to pay that back. I sort of like ideas like that. But again, these are not things that are, in my opinion, likely to happen quickly. And in that sense, monetary policy is there to be that buffer of, hey, if the fiscal authorities, if Hank Paulson is on his knees in front of Nancy Pelosi begging and the economy's rolling over, at least you got one group in D.C. that can kind of, save the day short term until we get that sort of impasse solved.